Welcome back, listeners, to Learning from Friends. My name is Cade Curtis, your tour guide in this lovely adventure that we get to do bi-weekly together. And today we have a very interesting topic of talking about mortgages. It's something that we all face, we all have to deal with as adults, and it can be a little complicated at times to fully understand the process. And so I was able to find a friend of mine, Katherine, who's going to come in and explain it to make it a little bit easier for us. And also, you could be able to go to her for some business if you would like to be able to learn more about this topic. So, but before we can get into this today, we got to do my mom's quote of the day. So, Mom, take it away.
And today's quote is from Fred Rogers. There are many ways to say I love you, and there are many ways to say I care about you.
Mom, thank you for always providing those words of wisdom and a great way to start off the podcast, because of that is setting the tone on the right foot. So with that, Katherine, welcome to the podcast.
Hey, thanks. Thanks for having me. I'm excited to be here.
Yeah, it's fun. It's kind of cold outside in January right now, and hopefully maybe we'll get some more snow. I don't know if you're a snow person or not a snow person, but we'll see kind of what happes.
I don't like cold weather person. If it snows, we'll have fun in it, but I'm ready for it to be 60, 70 degrees the next day.
So you don't want to worry about the ice or anything else out there. You just want to
No.
enjoy it for a little while and then be done with it.
Exactly.
So the large majority of the audience has yet to learn who you are. So if you had to make like a Wikipedia page of yourself, what would be some of the highlights you would like people to know about who is Katherine?
So I am a mortgage lender. I work for a company called S&P with the River Rock Group, and I've been doing mortgages for the last 10 years now. And when I'm not at work, I'm a wife, I'm a daughter, I'm a mom, I'm all these other things. I have 2 dogs. One is good, one is not, but we love them both. And if I'm not momming or working, then I enjoy hiking. I love to work in the garden. So just, anything that gets me outside, I really enjoy that sunlight time. So that's the why I don't like cold weather.
Yeah, because it keeps us inside. That's, it keeps us away from the outside joy, the sun rays coming down on us. They say the sun is one of the best medicines that you can be able to have is just
Yes.
sunlight.
Yes, absolutely.
So how do we know each other?
I started thinking about this question earlier, and I think we know each other through so many different mutual friends, but none of them are actually connected.
Exactly.
So I think what I pointed to most, I think, was Kyle and Kale. I think that I've seen you more with them when we're hanging out with them than anybody else. But of course, there's Ashley and there's a few others that we know together. And so I think I had a hard time narrowing this question down, but I think it's through the Hicks.
Yeah, that's really the key one. I agree as well. I was thinking about that this afternoon as well. But we went to 2 different high schools, but we had so many mutual friends that connected, but we never really like actually connected until like post college, really.
Yeah,
Like
yeah,
that was
exactly.
really kind of started to talk and kind of get to know each other in a way. But it's funny how the world can be that way of you could have all these different friends that are connected together, and then on the outskirts is more friends that connect to other friends, and eventually it all comes full circle. But it's like you've known someone for maybe 30 years but didn't know it.
Right. And the world just keeps getting smaller the older I get. So
It's true. So before we get started, can you introduce some maybe vocabulary or jargon or terms that you may use that perhaps will make it a little bit easier to understand as we go through the podcast?
Yeah. So as I was taking notes, I noticed I was using some of these words a lot. In the mortgage world, we like our acronyms. So it's a whole new alphabet that you kind of have to learn. And no, you
I think
forget that
everybody
people
does.
outside,
Yeah.
right? You forget people outside the mortgage industry don't know what these mean. So PMI is a big one. That's private mortgage insurance. You'll hear me talk about that a little bit. Your debt to income ratios, that's how much money you make versus how much money you're spending. LTV, or loan to value, that's how much your down payment is, how much is your loan versus how much is your house worth. We talked during the process, we talked about processing and underwriting and closing. Those are words you'll hear me say during when we're talking about what happens while you're getting a mortgage. So these are kind of the 3 big facets of it is processing, underwriting, and closing. I also talk about guidelines a little bit. Everything that we do refers back to the guidelines that have been written on each loan program. That basically tells us what we can and can't do for each loan. And all of them are different for each program. So I'll come back to that a little bit later too. And then I use the term first time homebuyer a lot. And this is something a lot of people don't realize, but a first time homebuyer isn't just somebody who's never bought a home before. It's actually somebody that hasn't owned a house in the last 3 years.
Oh.
So when you hear me say first time homebuyer, I'm referring to anybody that hasn't owned in the last 3 years. So what is it, 25 now? So since 2022. So if you didn't own a house prior to that, you're still considered a first-time home buyer and you still get to take advantage of some of those programs. So I wanted to make sure that that was clear before we got too deep.
That's awesome. I didn't think about that. That is something I always same understanding of first-time home buyer. It's your first time, and maybe, but really in honesty, it could be, as you said, 3 years. That's pretty cool. That's an interesting little
Yeah.
small tidbit to start us into this here.
Yeah,
Are
exactly.
are there any stereotypes or misconceptions that you would like to address with the topic of mortgages?
I would. There's a whole bunch of them. Google is such a good place and it's such an evil place all at the same time.
I
So
agree.
these
Technology can be your best friend, but your worst enemy at the same time.
exactly. So these are some of the questions that we get more often than not is PMI, so private mortgage insurance. Everybody thinks that private mortgage insurance is bad. There's a lot of financial gurus out there that say that you have to save up 20% before you buy a house, and that's just not the case. Mortgage insurance a lot of times is temporary depending on your program. And just for me and my husband, for example, when we first bought our house, our mortgage insurance was about $60 a month. And the difference in how much we would have had to save to get 20% versus $60 a month, it would have taken us about, I think the math ended up being about 13 to 14 years
Oh,
at
wow.
$60 a month to save up 20% for a down payment. Whereas we actually dropped it early. We actually dropped it after 3 years of being, or no, I'm sorry, we dropped it after 2 years of being in the house.
Congratulations.
Thank you. And so yeah, it was worth not putting that full 20% down because we spent way less money over the course of our loan. So a lot of people think it's just a way for the mortgage companies to make money, but it's really just kind of like, I mean, it is, but it's like training wheels for buying a house. And once your equity gets high enough, you can drop it. So it's not a bad thing to have it. It helps people get into a house sooner and it helps you build that equity faster. So that's one of the big things. And that kind of leads into the next thing is you don't actually need 20% down. A lot of people think you do have to have 20% down. There's programs out there that go from 0% to 3%, 3.5, up to 5%. And those are kind of the minimums. The only time you need 20% down is if you're buying an investment property.
Oh,
So
okay.
it's not, yeah, so it's not, it doesn't take as long to save up that money as a lot of people think. And then lastly, FHA. A lot of people have this bad connotation of FHA loans. That's FHA stands for Federal Housing Authority. They have a little bit looser guidelines. So somebody that has a little bit lower credit can get into it. Somebody that needs a little bit higher debt to income ratio,
Okay.
they can get into it with an FHA. This is also a good option if somebody, and things happen. If somebody has a foreclosure or a bankruptcy on their credit, then an FHA is a good way to go. And it doesn't mean that you were bad with credit, it just means something happened. And
Mhm.
so the guidelines are a little bit looser when it comes to FHA. So
Ah, so you get
those
that
are
extra little assistance. I like that.
yeah,
Yeah.
exactly. So those are the three big ones that when I was thinking about this question that we get a lot of pushback on.
Yeah, I can imagine that's as you said, looking up on Google, you can go for hours of getting stuck on a rabbit hole, and everybody has a different opinion when it comes to buying a house.
Mhm.
Now, how did you get involved in this field of mortgages? Because of it's not something that I would have thought about in high school or in the beginning of college.
Yeah, nobody does. This is this is not a field people go, "You know what I wanna be when I grow up?" This is actually all my mom's fault. So
Good old
it's
moms. Gotta love the
yeah, it's
moms.
it's her fault. So she's actually been in the industry, for 43 years. So she's been doing this, I wanna say a lot longer than I've been alive, but I wish I could, but I'm approaching that big number too.
We're
So
all getting there. Yep.
Yep,
Time
yep.
keeps
So
going.
exactly. So, and I swore I wouldn't get into the mortgage industry because I watched my mom work so hard growing up, but then at the same time, she was at every single game. So
Ah,
it comes with a lot of flexibility, and I love that about this job. So I got into it because I was working with a previous employer. I was actually their marketing manager. And so I had routes and everything, and I would go door to door and basically try to sell the service. And eventually I realized that this was being it was run by it was a family franchise. So I realized pretty quickly there was really nowhere for me to go or improve or get
no.
better or bigger
Okay.
because the next step up was owning the company. So
Yeah, that's a big jump.
yeah, yeah. So that wasn't something that was on my radar. So after that, I was actually interviewed and hired by my mom's company because they saw what I was doing for this previous company as on the marketing side. And so they hired me on and I started running all the social media. I started doing the marketing, going to the events, all this other stuff. And then my boss said, well, hey, if you get licensed, then you can actually talk more about rates and things. Because there's certain things that somebody who's not a licensed mortgage lender can say. So if
Okay.
you're not licensed, you can't talk about rates. You can't talk about how much it costs and that sort of thing. It's actually illegal and you face a fine. So
Oh, wow.
he suggested, yeah, exactly. So it's a liability. So he suggested I go ahead and get licensed. That way I could start talking about rate and certain costs that are involved in the process. And then shortly after that, he said, you know what? Hey, while you're licensed, why don't you just go ahead and start selling loans and start doing mortgages
Oh, wow.
and start
It's a lot of
originating.
responsibility. Yeah.
Yep, yep. And so now here I am doing loans. So I feel like I kind of got swindled into it, but it's worked out. So it's all good.
That's what matters the most is you're happy with what you're doing. You're able to find that proper work-life balance, and finding that time with that flexibility is so key because so often in life we all struggle with trying to find a good balance and being happy with what we're doing at our work. And that's the key thing right there.
Absolutely. And it's so rewarding to actually being in this industry to be able to help people achieve the dream of home ownership. It's really cool to see some of these people who never thought that they could buy a house realize that they can, and then we go to a lot of our closings. We get to see how excited they are when
Oh,
they're like,
yeah.
"Oh, today's move-in day. We've ordered pizza. We bought some Clorox wipes, and so we've already picked out our rooms." And that's such a cool feeling to know that I helped make that happen.
That
So
is.
that's something that I really enjoy about this.
Now there are all different types of loans that are out there. What are some of the most common types of mortgages, and how are they different from each other? Because there's just so much out there.
There's a lot out there. So the 4 basic programs are they're gonna be FHA, VA, USDA, and conventional. Now the first 3, the FHA, VA, USDA, those are all government-backed programs. So those are programs that the government put into place to help people buy houses. And so they're regulated by the government. So the first one is we talked about this earlier is FHA, it's a federal housing authority. That one allows a little bit lower down payment of 3.5%. That's all you need to get into this one. This one also
Okay.
has a really good renovation program as well. So if you find that house it's in the perfect location, but it's either kind of ugly or it's run down or
You
something's
need some
wrong with
extra
it.
tender loving care.
Yeah. This is a program where you can finance those costs into it. And what's really cool is you can even finance things like appliances. So if you need a refrigerator or the stove isn't working, or even a microwave, you can finance those things into this loan.
Huh.
So I know there's a lot of first time buyers out there, especially that they've saved up for a down payment. They're not looking at buying a $1,200 refrigerator.
That's true.
So this is a good way to do that. This one also allows for a little bit lower credit. A minimum score of about 580 is what they're looking for. We can go lower, but it requires a higher down payment. And one of the things that sets this apart from some of the other loans is that it does require an FHA certified appraiser. All the appraisers come from the same pool, but some of them have extra certifications that allow them to do different types of loans, and FHA is one of them.
Okay.
So the only downside to it is you can't own 2 FHAs at a time, 2 houses with an FHA mortgage at a time, and you can't use this loan to buy an investment property. And then lastly, the private mortgage insurance, it's actually mortgage insurance that's on this. This one stays there for the life of the loan. So if you put the minimum down, that mortgage insurance payment will always be there until you refinance or sell the house. It is based on the loan amount, so that mortgage insurance resets every year. So it does drop, like the amount goes down, but it stays with the loan for the life of the loan.
Interesting that something like that can be able to stick with it the whole way through or temporarily and all the different that's always you gotta have someone that's backing you up, that's taking care of you whenever you're at these, getting these mortgages in place, which is why we have people like you that can be able to help protect us and make sure that we're doing the right thing.
Yes, hopefully, hopefully. So one of the next ones that I want to talk about is the VA loan, and that's the Veterans Authority loan. So this is a loan that's specifically for veterans. The cool thing about this one is it really takes care of our vets. It's the best loan that's out there, but of course you have to have served or be a surviving spouse in order to qualify for it. You don't have to put any money down with this loan. You can get
Oh,
into the
wow.
house for 0% down. There's no mortgage insurance on this loan. Again, they want to take care of their vets. There's a funding fee, but that funding fee is actually waived if a veteran has a disability rating,
Okay.
and it can be as low as 10%. So I mean, any small amount of disability will help you avoid that fee, which unfortunately a lot of our vets have that. I mean, it's a good thing because they don't have to spend as much money, but then they
True.
also have to deal with a 10% disability or more. The other cool thing about this is it's not based on a debt to income ratio.
Okay.
So you can go a little bit higher because it's based on what we call a residual income. And that's basically your money that's left over after you make all of your minimum payments. So as long as you have enough residual income, it doesn't really matter how much debt you have. So this is a lot easier to qualify for. And again, credit score of about 580.
Okay. It's good to know because everyone has a different approach and different options, and it's good to know that there are those options there for a person because we don't think about it. All we think of is like one or two, but whenever you have all these different options out there, it's like getting a box of chocolate. You never know what you're gonna get.
That's very true. That's very true. And everybody has these are the four basics. And there's always those one off and out of the box programs that most lenders have. Every lender has a little bit something different, but this is kind of the basis of where it goes.
Okay.
And so the next one on our list was the USDA loan. The mortgage insurance on this one is financed, so it's actually rolled back into the loan amount. And this one also has to be a rural loan. So the big thing with USDA is that they have to be rural properties, and you can figure out if a property is rural by going online and searching their website and typing it in. Just for example, in our community, there is an exit where one side of the exit is USDA territory, whereas the other side is not.
Hmm.
And so it's a very close line. So we always look that up. We always look up the address when somebody tells us they want low down payment or no down payment.
I wonder how they determine that line. That'd be very kind of interesting to see because that's really like seems like one side of the exit, the other side of the exit. That would they could be two total polar opposites. It's interesting.
Yeah, yeah, it is really interesting. And from what I can gather, it really has to do with population and statistics and things like
Okay.
that. So a lot of this information that we gather, we have to ask certain questions, and the government uses that to determine what should be considered, USD eligible. What kind of programs do people need right now? What kind of things do we? And these lines get redrawn based on development. So
Okay.
as like the metro areas grow, some of the USDA territories may start to shrink. So it's always worth looking up an address just to see if it's in that area.
Yeah, definitely.
And I don't think I mentioned it, but it is a 0% down program. So there's no money required for this one,
Oh
just your
wow,
closing
nice.
costs. So yeah. And then lastly is the conventional program. And this is your vanilla, your baseline. This is the program that you hear about more often than not. This one has certain programs where first-time homebuyers are eligible to put as little as 3% down. Otherwise, if you're not a first-time buyer, then you need to save up about 5% for this program. This one has mortgage insurance. The mortgage insurance is based on the credit, the debt to income ratio, and the loan to value that we talked
Okay.
about. All those things that we talked about earlier. So this one, all of those things are based on that number is based on those things. The cool thing about this loan, though, and like I said at the very beginning, is your mortgage insurance can actually be dropped early.
Oh,
So it's typically there for about 10 years. But if your value jumps up, then you can actually contact your mortgage servicer. And this is something I tell my clients constantly because you don't have to refinance to drop this. You call
okay.
your mortgage insurancer. Yeah, really cool. So you call your mortgage insurancer or mortgage servicer and tell them, hey, I want to drop my mortgage insurance. So they'll send an appraiser out to your house. They'll look at improvements. They'll base the value on recent sales in the neighborhood or the area. And if your value is high enough, then they'll say, yeah, we think that you're okay. We'll go ahead and drop that mortgage insurance.
That's
There
nice.
is, yeah, yeah. And sometimes I think you have to make like 24 payments for most servicers before they'll agree to drop it. But I mean, I have some friends that I did their loan, gosh, it was right before COVID. I think it was about 4 or 5 years ago. And their mortgage insurance is about $200 a month. So at this point, all they have to do is contact the servicer, ask to drop the mortgage insurance. They pay for the appraisal, which is about $500 to $600 or so.
It's gotta be worth it though in the long run. That could be so much worth it.
Well, if you think about $200 a month, that pays for itself in 3 months. So
Exactly.
it's absolutely worth it. So that's a way around all of that. And the cool thing about this program is this can be used for your primary house, your second home, or an investment home.
Oh wow. Okay. So you can use it for multiple. It's not one that's limited. Nice.
hmm So yeah, those are the four basics, but each one of them has different little facets. Like FHA has what we call down payment assistance. So you can actually finance your down payment so you don't have to come out of pocket. One of the questions you have later, this will probably come up a little bit more in conversation, but it's a great way to get into your house quickly without having to save up a ton of money. So
Yeah,
there's a
because that's
lot of
always a big gatekeeper kind of in a way of trying to find
exactly.
that money and that payment to be able to get into it.
Exactly. So there's a lot of stuff out there. Like I said, down payment assistance is something that we're seeing a lot of. And again, I don't I don't want to spoil all your questions, but that we'll get into that when we
No,
get
it's
to the
all
trends in
good.
the market.
If we get into there, we get early, we get there early. It's okay. Now, can you walk me through the typical process of securing a mortgage for a client? Because you said there's so many different ways to be able to do this. Like, how does it work from your end?
Sure. So we always recommend you start with a pre-approval. There's a big difference between you'll hear the terms pre-approval and pre-qualification thrown around, and there is actually a big difference. A pre-qual, you tell us what your income is. You say, "Yeah, I've got good credit. Here's what I want to buy." And we think, "Okay, well, the numbers add up, so we think you could probably get the house." Whereas a pre-approval, and most people don't accept a pre-qual anymore. They require the pre-approval. A pre-approval is either a full or a soft credit pull. So we're actually looking at your credit, we're looking at your debts.
Okay.
We check your pay stubs and W-2s to make sure what your income is. And then we look and see what kind of budget you can spend. Like what's your buy budget versus what you want to spend sort of thing. So that helps set the stage for what we're looking for in a house. I hate when I have to break a client's heart who's been looking at these, gorgeous $500,000 homes when they can only afford a 350 home.
Yeah.
And so it's important to know what you can do before you start shopping and get your hopes up.
Yeah, you don't wanna get yourself into a very bad position.
Right,
Yeah.
right. And then on the flip side of that, if let's say you can afford more and you didn't realize you could, now it opens up your options. So that pre-approval is really, like I said, it really sets the stage for the entire process and your experience. So that's a one-on-one conversation, that's an application, and then we look through all the numbers and we crunch it and we say, here's your three options, here's what you can do, and here's your budget. At that point, you can start searching for a house. I highly recommend using a realtor. I know there's a lot of really fun stuff about realtors in the news lately.
Yeah, there's been a lot.
Yeah, with settlements and stuff, I recommend just Google that. Google the NAR settlements. I'm not even gonna go into it, but I will say a realtor is worth every penny just because they understand how the contract works, they understand how the negotiation works, and it's worth having a realtor take you around to those areas. They also know what areas are good versus what areas are bad. So, I mean, you and I are both from Atlanta. We know that there's good parts and there's bad
Yes,
parts.
there
And
is.
so if you're not, then you need somebody to tell you these things. So I recommend doing it with a realtor.
Yeah, they've got the education that they've spent the time to do in order to become a realtor. You can't just walk off the street and become a realtor. You really have to
Right.
spend that time to really get to know it.
Right. And I don't think a lot of people realize that realtors actually have to take, I think it's about 12 hours each year of CE, of
Yep.
continuing education. So they're constantly learning, constantly improving and growing. And contracts are changing every year because new lawsuits pop up. And so, yeah, there's a lot more to it than just, yeah, let's agree to buy the house for a certain price. There's a lot more to it. So realtor takes care of that.
They do. That's what they're there for. They're there to help you.
Exactly. They're also going to help you with that contract and negotiation. Like I said, once you find the house you want, you're going to put a contract on it. Hopefully it gets accepted.
Yeah.
Moving, if it doesn't, you can counteroffer or you find the next house. So,
Yeah. True.
and then once you're under contract, that's when we step back in. We send out what we call initial disclosures. And that's just kind of here's the outline of your loan, here's all the numbers that we talked about. Those are not set in stone. That's just kind of meant to be looked over and make sure that everything's right, make sure that we got all the information correct. At that point, we'll order the appraisal and the title. And the appraiser goes out and makes sure that the house you're buying is worth what you're spending on it. We want to make sure the value's there, that you're not overpaying for it.
Okay.
That's always based on local market data. What, like I said earlier, what's sold in your area, what's, improvements, things like that. And at that point, we submit it to our loan processor. Our loan processor, their job is to basically cross all the T's and dot all the I's to make sure that we got every bit of information. And then what the processor does is actually writes a story about your income and your debts and everything and presents it to the underwriter in a way to hopefully get the underwriter to approve it.
Okay.
So we always say during that application process, don't not tell us something and we'll figure out how to present that information.
Yeah, being transparent goes a long way because if they pull up something that they found, like, oh, this, why did you not tell us about this bankruptcy, or why did you not tell us about this? And it kind of can look bad on you as an individual for trying to get that
Exactly.
loan because they have to trust you because they're giving you
Exactly.
that ton of money.
Right, right. And those things, like you said, bankruptcies or foreclosures, those things do show up on a credit report, but something like child support isn't going to show up on your credit report. unless there's been, a judgment against you. So when we ask those questions, are there any debts outside of your credit? That's kind of what we're talking about because we have to take that into consideration when we're thinking about your debt to income ratios. So don't hide anything from us because we're going to find it somewhere. I had somebody at the last second they were trying to do a income driven mortgage, and at the last second, we had started noticing that there were deposits on their bank statements every single month, and they were the same amount
Hmm.
every single month. We said, "Hey, what's this?" And she said, "Oh, that's my child support." So she's collecting child support, and that little bit amount of money that she was getting actually pushed her over the income limit for the program.
Oh.
And so it messed it up, right? And then, vice versa, if somebody else is paying child support and we don't know about it, or an alimony or whatever, these are just examples, then they may no longer qualify for the loan because their debts are too high. So, like I said, you're like to use your word, transparency is key in the beginning. So once a processor finishes their job, they send it to the underwriter, and the underwriter is kind of we joke about if we had wrestling names, we would be the underwriters because it's kind
Yes,
of
good tag
it's
team
the
right there.
scary part, right? Is the underwriting that's somebody who's actually judging you for everything that you've ever done, or at least the last 7 years. But no, they're actually really nice. They are people, and they actually are really nice people. But they decide whether or not your credit history is worthy of extending that amount of money to you. So they wanna make sure that you're gonna pay back, the hundreds of thousands of
Oh,
dollars that you're
yeah.
borrowing. So that's their job,
They have to
and
trust you.
right, and that's why we look at all of these things. So and he or she may come back with some conditions of your approval, or they may ask for more information. Once we get through all the underwriting and everything, and you've provided everything, your first child's blood samples, urine samples, those things, we move on to the final disclosures, and that's where we kind of say, "Okay, we're gonna revisit this, make sure all these numbers still look right, make sure all this information is still correct, and then we move to closing." And in Georgia, we are an attorney state, so an attorney closes the loan. Some other states close in escrow, which means there's kind of like a holding period or a waiting period. And then other states are title states. And that just means that somebody who searches the title is the one that closes it. Georgia is an attorney state. Florida is a title state. We're licensed all over the Southeast. So each one's a little bit different. But regardless, your job at that point is to sign the paper and get your keys.
Nice. That's always a good feeling at the end of the day when given signing the paper and getting the keys.
Yes.
They're heavy keys because you realize the weight and the debt that comes with it that you have to make sure you pay off.
Yes.
But it's great.
What's really funny too, though, just a point that you brought up, the average loan amount or the average time that a loan is actually active is only about 5 years. Did you know that?
Really?
So people are either
No.
going to sell or refinance within 5 years of owning their home. So when you're thinking about the commitment, that heavy commitment of buying a house for and paying for it for 30 years, the chances of that actually happening are very unlikely. So just something to
I'm
keep
trying to
in
think when
mind.
I refinanced.
Yeah, yeah,
I'm trying to think,
exactly.
like, I financed during COVID, we bought in 2015, so yeah, actually 5, 6 years.
Mhm,
Yeah.
mhm, yep.
Wow.
So it's almost like we pay attention to that market data.
Hey, it's important to do so. That's part of the job. That's the part of the whole thing. You gotta understand the data to be able to read, to be able to help.
Right.
Now, what strategies do you assess a client's financial situation to determine the most suitable mortgage option for them?
So this is always a conversation, and this is where having a loan consultant instead of an app is really beneficial. I always ask the first question: is this going to be your first home, or is this a home that you are you planning to sell a house? So that
Okay.
that helps me. That first question right there helps me figure out what program to start with. So if they say it's a first time home buyer, then I'm thinking of all the different programs that they might be able to do. If it's somebody selling a home, then I'm thinking about programs where they might have a down payment, or are we paying off debt or whatever. So anyway, so that first question, what kind of home are we buying? We also ask what's your goal, and what's your spending goal versus what's your monthly payment goal, because those are two very different things. And I will say with millennials and the new Gen Zers coming up, they've already done the calculations and they kind of know what they can afford, which is a great thing. It's really
Saves a step.
yeah,
Yeah.
yeah, it's great to know what you're comfortable with. That's kind of my next question is, I ask what's your payment goal because I want to know where people are comfortable. I don't want to say you can
Yes.
go, you can afford a $4,000 payment. That doesn't mean you should. So
That's definitely true. Yeah.
so that's why that question is so important is what is your spending goal, your monthly spending goal? We also ask about ideal price range. And a lot of times, like I said, with the newer generation, that price range will actually line up with that spending goal. because they've done their research. But oftentimes, if it comes in a little bit high, then we need to kind of reset those expectations.
Mhm.
So if this is your spending goal, let's back into your purchase price. And then finally, the reason I asked that question, the reason I want to know what people's comfort level is because we are a big proponent of sustainable housing.
Okay.
I don't want to write a loan that I know will become a foreclosure in the next few months or years. That
That's
actually
true.
that actually reflects poorly on me or our company when we're writing a bunch of loans that are going into foreclosure. It means that we've overextended our clients. And that's not good for a community. It's not good for a person. It's just, we really focus on that sustainable housing. And that's why that question is so important of let's make sure you're comfortable making this monthly payment so that you can be successful in building that wealth essentially and building that generational wealth with a house. So once we come back to that and we figure out what all of our goals are, that's how we start determining and chipping away at all these different loan options to figure out which one or two would fit this person the best.
Yeah, and it's a lot of psychology there that you have to be able to think about to be able to do that, and being able to have, as I mentioned earlier, and you mentioned earlier with the transparency. If someone has done the research, doesn't mean that necessarily the research was always correct to start, because that they can get really, we can get lost in the weeds sometimes, and what we think may be our right number may not be the right number. And that's one thing that I'm glad that we have people like you to be able to help support us, to be able to help make these proper decisions and understand what resources are out there, because there's so many programs and so many options available for people that we just don't know, unless you're in that business, unless you're in that capabilities, and people asking those questions. And that's why you ask the questions, in order for them to be able to learn what they need to know. And I'm sure they have tons of questions that they ask you, which opens up new perspectives as well.
Exactly. And I will say, the research isn't a bad thing because that leads to a lot of great questions and it helps me understand what my
Sure.
clients want to know moving forward. So that I appreciate the researcher. I really do.
Same here. I'm always about, if you have a question, I'm always about asking questions. It's a comfort thing for me. So how has the mortgage lending landscape changed in recent years? Because we've gone through COVID, we've gone through all these different other transitions. And what advice would you give someone who is navigating the market like current day to day? Because we're in January of 2025.
Yeah, so this is kind of a loaded question. The question should be what has stayed the same? Because
Oh, okay.
it feels like everything has changed. It'd be a lot shorter conversation. We just talked about what hasn't changed. But I mentioned earlier guidelines. Guidelines are things that changed based on, again, market data. I will say one of the biggest things that changed during the whole pandemic era is student loan calculations. So
Yeah.
there's a lot of people who have student loans out here. I think it's like something like 60% of Americans or something ridiculous.
Yeah, it's a large
Yeah,
number.
it's a huge number. And those student loans carry a lot of weight on being able to afford a house. Well, during COVID, people aren't making payments on those student loans. So some people are, but some people aren't. They're able to save up their money a lot faster. But
Mhm.
it's still a debt that we have to consider. So the way that we calculated that monthly payment changed because all of a sudden, if you recall, all the student or most of the student loans went into deferment or forbearance. There were no payments being made. So when we pulled a credit report, it said zero on the credit report that there was a zero payment due. Well, we still have to consider the fact that that's a debt that's owed and it eventually would have a payment again.
Yes.
And so we actually had to figure out a way to calculate that. So that was one of the big guidelines that changed. And each loan program had a different calculation. So that was fun figuring it. We had a little cheat sheet so we could calculate student loan debt.
Dude, cheat sheets are the
Yeah,
best.
yeah,
You gotta have
exactly.
that.
We also learned, so going even further back to the first crash in 2006 to 8 ish, somewhere in there. I think it was 2008 was the actual crash.
Yeah, and then it stayed around for a couple of years
Yeah,
to kind of rebalance back.
yeah. I remember because like I said, my mom was in the mortgage industry, so we actually started seeing the effects of the crash coming in 2006. I very vividly remember that, and then the crash at the bottom actually kind of fell out in 2008. So when that happened, all the powers that be looked back and said, okay, so what caused this? What caused so many people to walk out on their houses? What caused so many foreclosures? And you may hear the joke, if you can fog up a mirror, you can buy a house. And that's basically what it was. We had things
Oh,
called stated
okay.
income loans. And that was just, I could tell you I make 250,000 a year. Okay, sure, you can buy a house. And that's literally how people were getting houses. So,
Oh, wow.
yeah. So there was a lot of risk involved in a loan like that. I mean, could you imagine just giving somebody hundreds of thousands of dollars because they said they made so much? And, so that so
Yeah.
that caused.
That's definitely a recipe for disaster,
Yeah, exactly, and
which it was.
so that actually caused our debt to income ratios to be a little bit more strict on loans. So that's why it's such a big deal to look at those numbers and why certain programs are so specific about what those can be and how high they can go. Down payment guidelines have changed. The 3% down program didn't exist before COVID or didn't exist before the crash. So a
Okay.
lot of research went into what caused that, what kind of risk assessment each of these had, and then guidelines changed based on those current market risks. So that's in a nutshell, without having to go through 500 different guidelines. That's kind of what's changed. Some of the big things. One of the other things too, job gaps. We had a lot of job gaps during COVID.
Oh,
So
yes.
that came into consideration, and people actually had to rewrite the guidelines based on job gaps because people were getting unemployment who weren't actually unemployed. So there's a lot of things that we had to consider because we couldn't just stop giving loans. We couldn't just stop selling houses because I
It's
don't
true.
know if you know this, but housing market is such an economic driver. And that's kind of
Oh,
that's kind
yes.
of why they
Yeah.
pulled the rates down, was so that that market wouldn't stall during the last crash, during the COVID crash. So, like I said, any kind of major world event, that's going to cause those guidelines to change.
That definitely was one of
Yeah,
those,
yeah,
for
for
sure.
sure. And
Yeah.
then the other part of your question on advice to give people, I would say that even though the prices and the rates are high, it sounds like a broken record, but I know when my mom got into the industry, they were looking at 13% interest rates, which makes.
Yes, and that's totally
Right,
totally
which
different.
makes 6.5 not feel so bad. And so that's actually kind of a healthy market, is when your rates are in the 5s to 6s. And so,
Okay. That's good to know that
yeah,
number.
yeah, that's actually considered a healthy market. So even though the rates and the prices feel like they're high, they're just gonna keep going up. Housing is one of those things that will always appreciate it, and just like any investment, it may take a dip, but it's gonna come right back. So my recommendation is, if you are financially comfortable enough to buy a house right now and take on that responsibility, do it now and don't wait for it to get more expensive, because it's just going to get harder.
True.
It's going to get harder to save that amount of money. It's going to get harder to afford that payment on the house that you want. Just go ahead and buy the house now and let that equity start working for you. Because a lot of my friends who have bought houses at this point are in their second home. That first house that they bought, that house paid for their next down payment on the next house because of the equity growth. So
Ah.
it's, yeah, get into the house now and then let it work for you. That way you can start moving into what you want.
Yeah, that goes a long way, and definitely your house is one of your biggest investments that you do have. That's a true statement. I know we're fortunate that we bought when the market was lower, and we're reaping the benefits right
Mhm.
now of that. And we were able to refinance during whenever things were the market was and during COVID, and that has made a big difference in us for our payments and everything as well. So there's always, as you said, ups and downs
Mhm.
within the
Mhm.
market.
And just catch it at the right time.
Yep, exactly. Now, what key factors do lenders consider when evaluating a potential borrower's mortgage application?
So credit and credit history are the big things. Like I said earlier, we do either a soft or a hard pull depending on your credit situation. We look at there's a lot of different factors that come into it. Do you have a pattern of late payments? Do you have a pattern of missing payments? Do you have a
Oh,
pattern of repossessed cars, things like that? And that's why it's actually like a 7 to 10 year look back, is to see if these kinds of patterns pop up. Now, I will say that sometimes somebody may not have the best credit. We look back at the credit history, and there's maybe 8 to 10 months where there's some missed payments and nothing before, nothing after. We can tell something happened during that
hmm.
time. So anyway, so credit history is a big thing. Your down payment, again, that helps us determine what kind of loan program we need to look at. Your debt ratios, that debt to income, are you overextending yourself, or are you within that certain ratio, that magic point? Below 43% is what we look for, actually.
Oh, so that's
Mhm.
the number.
Yeah,
Okay,
43 is a
43.
good point. We
Okay.
can go up to 50-ish, but 43 is kind of the magic number. Make sure that your income isn't what you're spending is less than 43% of your income, is what we look for.
It's a good number to be able to know because if that's something that I was curious about that earlier, what that number would be whenever I was coming up with questions and come up with ideas. I'm like,
Yeah,
that
yeah. So
is. I like finances. Finances always find me
Well, it's
interesting.
good it's
For
good hard numbers and good hard rules, so just have to make sure that everybody fits those rules, right? But no.
that that's a
But
true
yeah, so
statement.
43% is about where it needs to be. 45% is still a good ratio, but once it starts creeping up above 45, then we might need more documentation. We might need more qualifying factors or whatever. And then once it gets up to 50, that's when we kind of leave it up to, have you been paying rent before? Are you going to have a payment shock? Are you able to save money? Those sort of things. So we take those into consideration once the ratios get a little bit higher. So basically, like I said earlier, we have to decide whether or not somebody is financially responsible enough to pay back a 10, 15, 20, 30-year loan. So that's why we're looking at credit history and looking at the ability to save. And something too I want to point out, I know a lot of people have a hard time with understanding how they can become approved because they haven't owned a house
Okay,
before, they don't have a lot of credit. As mentioned earlier, being able to save money is actually something that we take into consideration. So if we can see that you're consistently putting away some of your income every month to be able to save for a down payment, that tells us that you're responsible enough to not go blow your money.
true.
We call that reserves. So we look to see how many reserves you have. Do you have, 6 months worth of payments saved up before you buy this house? So once you've spent your money on the house, once you've spent your down payment and your closing costs, do you still have money left over to make 6 months worth of house payments? And so having money in savings is actually going to help you be able to qualify for a loan. We also look at, like I said earlier, rent history. Even though a lot of people think that rent doesn't count as credit history, it actually does. So if we see that you've been making a $1,500 rent payment and you want to buy a house that's going to cost you, let's say, $2,000, then okay, we can see that. We can see somebody moving
Yeah,
$500 out.
yeah.
Now, if you've been living at, I want to say living at home, but we have people that live at home all the time and they save money. But if you went from a zero house payment and then all of a sudden you want to buy this house that's worth $2,500 a month, that's a big
That's a
change.
big
Yeah, and
jump.
that happens
Yeah,
a lot.
it's a big
And it's
jump.
a big jump, and that's what we call payment shock. So if you've been paying rent and we can see that that rent is comparable to your new house payment, we take that into consideration. So it is worth making making your rent payment on time, and it does actually
Yeah.
count towards something, I promise. So, but yeah, so those are some of the things that we look at when we're considering approvals.
So what are some common mistakes, though, that borrowers make whenever they're applying for mortgages, and how can they be avoided?
So just like what we talked about earlier, the transparency. That is the
Transparency is so key in life. It's a great
that
it's a
is
great life goal.
yes. Yes. So the most problems that we run into have to do with borrowers not disclosing everything. Like I said, we have things pop up all the time like, "Oh, here's a surprise child support," or "I bought land from my uncle and I've been paying him back." Those sort of things that we see on your bank statements, they don't always pop up. We don't always realize it's a pattern until we get the next round of statements. So
Ah,
this is typically a 30-day process, and so when we collect our bank statements up front, we have 1 month. Well, by the time we get to that end of 30 days, another statement's dropped, and so we need that next statement. And sometimes we see patterns on there that weren't talked about in the loan application process. So those are some of the biggest things that cause issues. And some of the other things too is debts. People like to open new cards or buy a new car, or
yep.
so just don't go shopping until after your loan closes if you're gonna buy something. So, and this is one that pops up more than anything, and I don't know what rules I can say here, but we'll just say home improvement stores. There's a lot of big home improvement stores that you're excited to go move into your new house, right? And so you think, well, I'm going to paint this wall green, I'm going to paint this one yellow, and it's going to be this whole thing. Well, then you go buy all this stuff, and the cashier says, well, do you want to put this on credit? You can save 25% today. Well, now
Oh,
they've opened up a new
yeah.
credit card. We've had a new credit inquiry, and all of a sudden you have this debt, even if it is $30 a month, it's a $30 a month payment that we have to consider now. So we always tell people don't open new debts, don't buy new cars, don't buy new furniture. Just make sure that you're staying the path and that way nothing happens.
And that's a hard thing to be able to think about whenever you're going into a new house because you think of all these other different things that you wanna be able to do as well, and that's a very smart technique that I hadn't thought about fully of whenever you're buying the house of you're gaining one big debt, but then there's the other debts that come on top of that whenever you want to start moving in. And whenever you're looking at applications and stuff like that, you're looking for those patterns. Can you be able to maintain this? And that makes a lot of sense. If you introduce a whole new category, that's going to change your debt to income ratio and everything, like,
Exactly. And
entirely.
locally, we're in a smaller town. We've actually had somebody that pulled up to closing with a whole truck full of brand new furniture for their brand new house.
Oh, no.
And, I said, "Did you pay cash for that?" And she said, "No, I opened up a store credit." I said, "Okay, you're gonna have to take it back." So we actually made them, and like I said, it's a small town, so we had connections with the person that owned the furniture store, and
Oh,
we said,
good.
"You have to take this back because we can't have a new debt. We can't have her paying, monthly, $200 monthly for furniture because it's gonna blow the loan ratios." So, yeah, we've actually been known to tell people to take their stuff back or pay something off before closing if they open something new.
How's this being in a small town as well, that you can be able to everybody knows everybody and can be able to help out and make that work? Because if some places would be like, nope, they've already signed on the
Yep.
dotted line,
Yeah.
it's set in stone.
Yeah, we've gotten lucky with that one, so
Now there's some different types of loans that are out there, like, with rates, like adjustable and fixed rates. Can you discuss some pros and cons of adjustable rate mortgages versus, fixed rate mortgages?
I can. So a lot of people like to blame the ARMs or adjustable rate mortgages for the crash that happened.
Okay,
And the reason for that is that ARMs are just exactly what it says. It's an adjustable rate. So as the market changes, your rate may change too. So during the crash, people weren't anticipating their rates to change the way that they did and all of a sudden couldn't afford their payments. Going back to the changes in guidelines, that was one of the things that changed is now we have to discuss, your maximum possible payment when you have an ARM. So, like I said, going back to the ARM, so they move with the market. They're fixed for a certain amount of time. Whenever you hear like a 5-1 ARM, that means for the first 5 years, it's fixed.
okay,
And then the 5-1, the one means that it's going to adjust every year. So it's it means that it's gonna recast your mortgage or recast your payment each time that market rate adjusts. And some of them are 6 months, some of them are 12 months. It just depends on your loan program, and that's something that we discuss whenever, somebody's looking at an ARM is how often it's going to change. It also changes based on the new balance. So, unlike a traditional mortgage, if your rate changes, you don't have to refinance with an ARM. If the rate changes, then it calculates the new payment based on how much principal is left on your house.
okay.
So, with the new rate and everything. So, it actually, like I said, it's recasting every time your rate changes. These are actually really good loans or good options for somebody who may have a temporary work assignment and know that they're only going to live in an area for 3 to 5 years because they know that they're not going to have to ever worry about a changing rate. One of the big benefits, though, to ARMs is that when the market drops, your rate drops. There's a lot of people who had ARMs before COVID hit. Well, when the COVID hit, their rates all dropped down into the twos automatically. So they didn't have to refinance, they didn't have to do anything. It just their payment dropped. And if you're a savvy homeowner and you made extra payments or you kept your payment the same, you chunked away at that principal balance.
Oh, yeah.
And so because of that, your payment's really never going to be higher than it was when you first started because now your principal balance is lower. You know how much your rate's going to go up. So it's a matter of knowing how much your payment could possibly be and always being prepared to make that big payment. The downside though is that when, like I said, markets adjust, the downside to the rates is if the market adjusts up, so does your rate. Your rate is going to go up too.
Gotcha.
So again, we really focus on making sure that we qualify buyers based on the highest possible payment instead of that introductory payment. So
Yeah,
that's
because if that's changing, you gotta be prepared. Yeah.
yeah. Yeah, exactly. So it just takes somebody who's going to be responsible enough to make sure they're always prepared to make the most payment that might be required of them. But that's really the the big difference with ARMs versus fixed rates is exactly that is the changing rate. I will say though, with ARMs, and again, this comes in all the disclosures and everything is different. There are caps to how high the payment can be. So your ARM
Okay.
can only adjust up so much before it's at its max, and that could be 12%. It could be 13%. It all depends on what the program is and what your guidelines say at the time. So
It's a good question to ask then whenever you're involved is what's my max that it could be? And
yeah,
then, to adjust your rate to that to be able to say, "Oh, well, this maybe could be my max payment."
Yeah, yeah, exactly. And like I said, it always adjusts based on the current market. So as the rates rise, your payment may rise. If the rates drop, your payment may drop. So it's all it's a very fluid loan is what it is.
There we go. That's a good example. A good fluid loan.
Yeah.
I love that. Now, each year you said kind of things change within the markets and things change with new laws and new capabilities that kind of start passing out. Are there any upcoming changes or trends in the mortgage industry for potential homebuyers that they should be aware of going into 2025?
Okay, you asked me this question right as we were switching presidential candidates and races and everything, and we did a whole new we got a whole new president when you asked me this question. So yes,
This is
things
true.
are going to change.
There.
And in regard, and I'm not going to get political on here, but regardless of who's there, there's always some big changes that happen whenever somebody new takes office.
Yeah.
There's always different
New
regulations that,
ideas.
yeah, exactly. New ideas, new economy, everything changes. There's a lot that's kind of up in the air right now, and I wish I could give you a better answer to that. But we kind of have to wait and see, if tariffs do go through, how is that going to affect the economy? One of the things that we talk about in the mortgage world, and the word that we use a lot is violent. So the
Okay.
market, yeah,
You
it
have me
sounds
intrigued. It
scary.
sounds scary. Yeah.
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 So it sounds scary, but right now we're seeing a lot of violent market volatility. So it's crazy that we live in the world that we live in, because if somebody tweets out, this is what we're going to do to change things, then the market reacts. Or I guess it's not tweets
Instantly,
anymore, but whatever.
whatever you want to call it. Yeah.
Right, right.
Instant responses.
Right, exactly. And so as those things change, the market could change and may have to readjust. One of the things though, as far as trends that we're seeing in home buyers, is people are struggling to save for down payments. And I was actually talking to my mom. I call her my momager. I work for her now. So
Sure.
my momager. I was actually talking to my mom about this question. And, when I bought my first house, it was about 100, 150,000. So saving 3% of 100 is what, $3,000. So that's really,
Big difference. It's
that
not
feels
that, yeah.
right. That
Attainable.
feels
Yeah.
doable. That feels attainable. Whereas now a lot of these first time home buyers are buying a $400,000 house. Well, 3% down on that's $12,000,
Big
which
difference.
it's a big difference. And so that's one of the things that we're seeing people, especially our first time home buyers, struggle with, is coming up with the funds for that down payment. And even though it's only 3%, that's still a chunk of change.
Yes, it
$12,000
is.
isn't a little bit of money.
No.
And then on top of that, you've got your closing costs, and closing costs are typically 3 to 5% of whatever the purchase price is. So now all of a sudden, let's say you're buying a $400,000 house and you have to consider spending about 6% to get into that house. Well, that's almost $20,000.
Mm.
So
Mm-mm-mm.
that's a lot of money, that
Yeah.
that's a whole lot of money to put towards your first house. And somebody who hasn't established their career, who's fresh out of college, who hasn't, they might still be working at the bottom of the food chain. They haven't made to that point where they feel like they can save $20,000. So one of the things that we're seeing a lot of right now, and this comes back to market trends, is how long are houses sitting on markets. During COVID,
True.
they were sitting for a week to 2 weeks at the most. If it sat for
Yeah, which
three
is
weeks, something
crazy.
right. If it sat for 3 weeks, something was wrong with it, right? So now the market's trying to correct itself, and we are seeing houses sit for a more reasonable amount of time, 2 to 3 months it takes to sell a house. So sellers are more willing to negotiate the price right now. And what we tell a lot of our first time buyers is, hey, go up $10,000 on the price and ask for 10,000 in closing costs. That's going
Oh,
to
that's smart.
right. So that $10,000 more on your loan is going to make maybe a $70 difference on your payment, whereas having $10,000 paid up front is $10,000 you don't have to save. Does that
Working
make
the
sense?
system that
Yeah.
the way it works. That's the way
Yeah.
that's smart.
Yeah.
Yeah.
So it's essentially like financing your closing costs, but so
Just doing
sellers
it
are
in a more productive way that be able to help you as the buyer.
right,
Yeah.
right. So if the market data says that yes, this house can appraise for a little bit higher, then we suggest, maybe offer a little bit higher and then ask the seller to pay some of your costs. And that's going to significantly reduce it. I know at some point in time, I looked at all of the loans that we had in their pipeline. Only one of them didn't have closing costs being paid. And of the ones being paid, I think there was something like $85,000 worth of closing costs that the sellers were paying out to our buyers collectively. So that's a trend that we're seeing a lot, is that sellers are more willing to pay those closing costs, or if your payment is a concern, then they're more willing to negotiate down on that payment or on the purchase price too. So there's a lot more negotiation power that we're seeing. And then likewise with people struggling to save money, we're seeing a lot more down payment questions, down payment assistant questions. What kind of programs are out there for down payment assistance? And so there's some new programs that have been coming out. There's some new, I know Fannie and Freddie, these are the big powers to
Good
be
old
on
Freddie
conventional
Mac.
loans. Yeah, yeah. They're coming out with new guidelines to help people get into homes, like different kinds of grants and stuff. I highly recommend checking your local municipality to see if there's any kind of grants in your area that are specific to like county. But that's something that we're seeing, is that the government realizes that we still need people to buy houses
Yeah, we
again
do.
so that
Yep.
the
The
economy doesn't
economy.
stop, right? And the thing with homeownership too is the more people in a community that own a house, the more they're going to care about the community,
Yes,
and
that's
the
so
better
true.
it is, right? And the better it is for that community. So believe it or not, they do want people to own house. It doesn't feel like that right now, but they do want people to own houses. So we're seeing more grants, more down payment programs, more seller paid closing costs. So I do think it's going to start getting a little bit easier for the buyer, not necessarily less expensive, but hopefully a little bit easier.
Yeah. You kind of like hit on this a little bit of saying that there is these programs and grants and stuff out there, but what are you have any recommendations of organizations or literature for people that are interested in to learn more about mortgages?
So I recommend going straight to the source. Google again can be overwhelming. I know that if I mean I have a degree in Google doctorate degree, and so I diagnose so I self-diagnose myself with all kinds of ailments that I probably don't have. So
Yeah, we all do with WebMD. We
right,
all do.
right, exactly. I'm sure that I have 17 different types of cancer, or
Oh,
but
wow.
it's not the case. That's not. It was allergies. It was just allergies. But it's fun, right? So anyway, on that note though, there's so many websites out there that are going to try to scare you. So I recommend going straight to the source. First of all, ask me any questions. I love answering questions, especially for first-time home buyers. I'm happy to do that. But aside from me, I would say look up the Freddie Mac or Fannie Mae websites and see what kind of research they suggest. Both of these websites have really good homebuyer education courses.
Mm,
And we actually teach, or we used to before COVID, we're going to get back into it, but we would teach home buyer courses based on the Fannie Mae courses.
okay.
It does a breakdown of credit, it tells you who's involved, it talks about the process, and it talks about how to care for your home and maintenance and the people that you're going to meet along the way. So I highly recommend checking out, like I said, either Fannie Mae or Freddie Mac websites. I believe Fannie Mae's is called the Home View, is their home buyer education. And then
Okay.
I think Freddie Mac's is called Credit Smart. But both of those are really good resources for getting real, unbiased information. FHA is also, I believe FHA has its own website as well, and that has a lot of good information. And the search bar, I'm pretty sure you can ask questions in it, and it'll help you find answers to that too. So, like I said, I recommend going straight to the source instead of trying to listen to the noise of everything else that's going on.
Yeah, the noise can be loud a lot of times, and everyone has an opinion. So, and you got to make sure that you're getting it from the right source. So, whenever I remember in high school in college doing research papers, you just don't go ask any Joe Schmo like about what it
Mhm,
is. So,
mhm. Exactly. Yeah. Get back to the basics. Cite your sources. So.
yeah, exactly. Now, we've covered a lot of different stuff. Is there anything that I've overlooked that you'd like to discuss?
Think we took enough, we'll call them side quests during that conversation. There is a lot to it. I will say that everybody has a different situation. Everybody's financial situation is unique to that person. So it's fun to try to figure out what programs fit and try to help people get to the point where they can buy a house. And if you can't buy a house right now, we help build a plan so that they can, whether that's looking at credit or helping you build a savings plan. But it's everybody's a different puzzle. So
That's true.
it's not a one size fits all thing. So I don't want to discourage anybody from even considering it. I think everybody deserves the opportunity to buy a house if they want to.
That's awesome. Great advice right there. I mean, great words. Now, you have a business. You work in a business. Promote it. Give us some information. Give me your 2-minute elevator speech.
Sure, sure. So I am a loan officer with a group called S&P Mortgage. We're the River Rock group of S&P Mortgage. Our office is located in Ball Ground in Georgia, but we're licensed from Tennessee, Georgia, Alabama, South Carolina, North Carolina, and Florida. So, like I said, all over the Southeast. I work with my mom, so together we have about 55 years experience. So we have a great company that wants to get you into a house, and we actually have an 83% success rate
Nice.
on loans that other people couldn't do. So that's just on the loans that people couldn't figure out. So yeah, we love working with new clients, and we have generational clients at this point. So yeah, if anybody has questions, I would love to talk to them, or if anybody's thinking about a house, then I would love to be that resource.
Is there an email or phone number or anything that they could be able to do to reach out to?
Yeah, absolutely. So my email is kfrance, and that's France like the country, at S as in Sam, M as in Mary, P as in Paul, so smprate.com. And then the best number is my cell phone number, and that's 404-583-5964.
Perfect. That's awesome. Now, are there any last minute words of wisdom? It doesn't have to be anything related to mortgages. It could be just in general thing of go buy gold. I don't know. What are any last minute words of wisdom that you have to share with the audience?
Don't wait. I think if anything that I've learned in this industry, it's don't wait for things to get better. Just dive right in and do it and figure it out as you go, because waiting is just going to make it harder.
Great words of advice right there. Catherine, thank you for giving me your time on this Sunday afternoon when it's cold outside and there's always little projects that we're trying to work on or get kind of ready for. And so you gave me your precious time, and I feel honored that you did that for me.
Oh, thank you for having me on. I've had a lot of fun, so I really appreciate it.
No problem. So, as we're all wrapping up down here, learning from friends, if you want to reach out to me, my name is Cade Curtis, CadeCurtis, and my email is cade, at learningfromfriends.com. I have a Facebook page. You can be able to message me through that as well. I have a X page since we're no longer using Twitter. And then I have a LinkedIn page and a Patreon page, all under Learning from Friends podcast. So if you'd like to just be able to reach out, say hello, donate some money to the cause of it all here of keeping this thing going. We're on, I think this is 94 episodes that we're going on now. It's getting bigger every day and getting up closer and closer to 100. So thank you all for coming in and spending your afternoon, your morning, your evening, however you are spending your day today. It's been a true honor and pleasure. And before we leave here, do you know the episode's coming to an end when I go, my name is Cade Curtis, your tour guide in this lovely adventure that I call Learning from Friends. And most of all, don't forget to let your curiosity fly high.